Hello and welcome back to Bunnex Investment Group. In this video, by the end of this video, you are going to be able to sell from these particular points, where in a week you are going to determine the highest point of that week or the lowest point of that week. In this example, we have week 1 where we could have sold at this particular point, week 2 where we could have bought at this particular point, and week 3 where we could have sold at this zone. So basically, we do not need any trading indicator within this particular strategy. So sit back, relax, and have somewhere to write and take some notes. Firstly, we need to highlight how the weekly flow occurs. Each and every week, a week creates a high or a low, right? This is inevitable for the market makers not to do so. There is always a point where they will actually have the highest particular price or the lowest particular price for that week. When the market reaches these points, it reverses. It will definitely reverse because market makers or trading institutions or any other high capital trading platforms do not have infinite capital. Therefore, at one point, they will need to book their profits and close off their trades. In doing so, the market will actually react by making a reversal. So these points, we call them extremes. So when I refer to extremes, I'll be referring to these points later in this video. Catching these reversal points allows us to ride the trend for a positive reward to risk ratio, meaning that if we make an entry at these particular points, we're definitely going to get a trade that will allow maybe a 2:1, a 3:1, or even a 4:1, depending on where we have made our entry, as we will discuss later in this video. However, the biggest question that you have now is, how do we get these particular points in subject? Let me explain. We are going to start off with the inside-outside structure trap. If we highlight this, you have a clarity of how you are going to catch those particular points. Firstly, most traders lose trades because they trade within the previous weekly structure. We are saying last week, for instance, we could have had a move like this, and then it had its high at this particular point. Those who know how to trade using the strategy that we are explaining right now may have entered at this particular point. However, on the following week, the market was actually within the structure of the previous week. Like in this case, it was still in this range, and those who will be trading within this phase have experienced a feeling of maybe the market is trying to fool them. Usually this zone is a play zone of market makers to trip and confuse traders the rightful market trend. Within this zone, you may feel like when you buy, the market sells, and when you sell, the market buys. So we are saying previous weekly outbounds or extremes is what we need to give more focus. By outbounds or extremes, we are saying these are the low or the high of the previous week is where we need to give our focus on. I'll repeat and emphasize that. Previous weekly outbounds or extremes is what we need to give more focus on. So here is how to catch these particular points. The first step is to mark the high or low of the previous week. We are in a new week right now, and we can go back and mark the high and the low of the previous week. By high, we are saying the highest price, and low, we are saying the lowest price. You can easily see the weekly flow on the H4 time frame. You mark the high and the low. Step 2, these points are the extremes. We are saying the high and lows are the extremes, and from either one of them, we need 3 days of rise or drop to reach the current weekly extreme. We are saying the first step is to mark the high and low of the previous week. Let's say this was the high. If we get 3 days from this high of the previous week, or if we get 3 days from the low of the previous week, these are the extreme points of the current week, and we call those points the points of midweek reversal. Step 3, in some cases, a move from the previous week is only 1 day, right? Let's say this was the high, and the market will just give us a 1 day from the move of from the high of the previous week, and reverse. If it reverse, we are saying within the market maker, institutional market maker method context, we call these points a reversal point. Therefore, this reversal point, that particular reversal point, becomes our extreme zone. This will become our extreme, where we start counting for the 3-day cycle from to reach the current weekly extreme. So we look for a candlestick reversal pattern or any pattern on day 3 from a validated extreme. Let's have real market examples. Before we see examples, please note that we have a free Telegram channel where we share free setups, signals, and trading tips. Be sure to be part of that community. So I'm going to use pound against dollar. As you can see, my chart is clear. There are no indicators. Another question that may arise is, where do I get these white lines? These white lines are basically marking the weeks. You can see that if we switch to the H4 time frame, the period separators will mark a period equivalent to a week. Like in this case, this is actually a week. This white line to the next white line is a week, and these black traces are actually marking a period equivalent to a week. And our analysis will be easier seen on the H1 time frame, where we can see clearly the days within that week. So I'm going to switch to the H1 time frame, and after that H1 time frame, we are going to start to count from in this case, we can see that this was a week that started on the 25th of September 2023 to the 2nd of October 2023. So what am I going to do? The first thing that we've said is to see 3 days of rise or 3 days of drop from the weekly extreme. So this was my previous week of this week. So my high was going to be this one, and my low was going to be this one. So we've said either from these extremes, I need to see 3 days of drop or 3 days of rise from that particular extreme. From this extreme, we can see that there was 1, 2, and 3 days of drop. After 3 days of drop, it means I have reached the extreme of this particular week. So we are saying 3 days from the previous week's extreme will give us a point of the current week's extreme, or what we term the midweek reversal point. There was a candlestick reversal pattern, a beautiful engulfing pattern on the H1 time frame that actually took me to the upside. On that note, we had a ride that could give us a positive reward to risk ratio. On this week, this was the previous week. The high was the low was this one, and the high of this previous week was going to be this one. We've said there are cases whereby the market will not give us 3 days of drop in that particular instance, but will give us only 1 day of drop and reverse. That 1 day of drop and reversal will become our new extreme. We are always going to trade after 3 days of rise or drop from a weekly extreme. So in this particular case, you can see this becoming a weekly extreme. We can have 1, 2, and 3 days of rise to the upside. There was a railroad track that was issued for those who love to trade these points as double bottoms or double tops, can as well apply that particular concept. So we could have short at this particular point and hold our trade up until it gives us a positive reward to risk ratio. On this week, this was going to be our previous week. The first step is to mark the high and to mark the low of our week, right? So we've said from the extreme, how many days do we have? We can see that we had 1, 2, and 3 days of drop. 3 days of drop, and from those 3 days we had a new weekly extreme. So basically that is how you will be doing to catch these midweek reversal points. You mark the high and low of the previous week, count 3 days from those extremes to reach the extreme of that particular current week. That note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.